It's happening, and sooner than we thought. The Federal Reserve just met and they dropped the interest rates 25 basis points. Now that's going to have a significant impact on the rate that Americans borrow and save money. Mortgages, credit cards, student loans, you name it. We're going to cover it all right here, right now. Now, to put this in perspective, we need to know that the federal fund rate is not the rate that actually people pay. The federal fund rate is the interest rate that banks charge each other to borrow money almost overnight, if you will. However, it does cause a huge ripple effect down to the average consumer. And when it comes to borrowing and saving money, it has a significant impact. So how that affects credit cards is you have to understand that 60% of Americans carry a credit card balance over and over from month to month. And knowing that the average consumer credit card interest rate being charged is around 20%, and that's near an all-time high. So you can see how when there's a 1/4 percentage point decrease, that does have an impact on the balance that you pay. It does have an impact on the interest that you're paying a bank for your credit card usage. Now, how the lowering of the rate affects mortgages is pretty easy. One, you're going to pay less on a monthly payment, or two, you're going to be able to afford more house. And the difference is, for example, on a $300,000 house that you purchased or borrowed $300,000 at 6.75% interest, 6.75% interest rate, as opposed to a 6% interest rate, you're looking at a difference of $147 a month. Now, that difference of $147 a month adds up to $8,800 over a period of 5 years. So you can see it can have a pretty large impact on your finances. Now, you have to understand that that rate doesn't affect immediately the mortgage interest rates. Like, it's not directly. It's like I mentioned before, it's what the banks borrow. However, it does have a trickle-down effect, because when the banks are saving money, it passes on to the consumer. Believe it or not, it actually does. Now, if you have an adjustable rate mortgage like an ARM, that does connect directly with the federal fund rate. So if the rates go down, you're going to see your interest rate drop. You're going to see your mortgage payment potentially drop. You're also going to have to consider that if you have an equity line of credit, not a home equity loan, totally two different things. An equity line of credit is when basically you borrow money against your house and you have a line of credit and you can purchase things on that line of credit and pay it off, and there's an interest rate. Those are variable rate mortgages. And that variable rate loan goes up when rates go up, and it goes down when rates go down. Now, just like credit cards and just like mortgages, automobile loans have a significant impact whenever we see a reduction in the rates. And most importantly, all of this has a factor in purchasing power and the rate that people literally just get out and make purchases and decide, you know, I am going to purchase a house. I'm going to put our house on the market. We're not going to put a pool in this house. It's cheaper to buy a house that already has a pool in it. It builds consumer confidence, because it's like, okay, the money's getting a little cheaper. They're kind of backing off the tightening of the interest rates, and it's getting more affordable for people to purchase a house. Now, don't get me wrong, home prices are still up. They're coming down in some areas like Texas, Arizona, and Florida. But I always tell people real estate is hyper local. Automobile loans, we're going to see an adjustment in those because it's going to be less expensive to be able to purchase a car. Now, all of this factored in, you have to understand that over time, when they lower the rates, more people buy houses. And when more people buy houses and more people buy cars, you guessed it, the prices go up. That's exactly why stuff is more expensive now. Ask anybody that you know that owned a house or bought a house 30 years ago, 40 years ago, what that address of that house is. And then go to Zillow and then type in the address of that house, and it will tell you what that house is worth. And be sure and ask them what they paid for that house 30 years ago. You'll be shocked. See, everybody says prices don't go up, prices stay the same, and why buy a house because the prices go down? Just do this one simple thing. Ask your mother, your grandmother, your grandparents, anybody. Maybe you yourself bought a house. If so, give us a thumbs up. If it's worth more today than what you bought it for 5, 10, 12, 15, 30 years ago. And then look that property up, because you're going to be surprised and amazed the value of that home today as opposed to even 5, 10, 15 years ago. Now, I'm certainly not trying to talk you into buy a house. You have to do you and be comfortable and live your lifestyle. But here's something to consider in how prices go up and prices stay stable and home prices come down. You have to know that inventory is up. It's a little bit higher than it has been because we're seeing more and more houses come on the market. But you also have to understand that fewer people are buying houses today. It's 2025 and fewer people bought homes so far this year in October of 2025 than they did last year, 2024. And last year was the slowest year for people to buy homes in 29 years. So you just have to understand that's when prices not only stable, but you see those prices come down. I always tell people it's not about the supply and the demand, it's the demand and the supply. And here's what I mean by that. When there's more and more supply of anything, doesn't matter what it is, and fewer people buying that, there's more competition. And when there's more competition, guess what? You have to get a little bit more realistic on your price. Anybody that puts their home on the market, you always want to make sure that you price it as well as you can, because you want to make as much money as you can. But at the end of the day, a home is only worth what a buyer's willing to pay. And if a buyer's not willing to pay for that house, prices come down. Now, the reason, as they say, for these cuts in the rates is the economy is stable and employment is stable, and the employment rate is not high. Not a lot of people are getting laid off from their jobs. The other thing that they say is the data that, and I don't believe this personally, just my opinion, I've been in the real estate business around all this stuff for 30 years of my life. They said that since the government shut down, they can't really see the data. And they know all that stuff. You and I both know they know all that stuff. Give me a thumbs up. You agree. You know, they know the data. But at the end of the day, the freezing of the interest rates has had a massive impact on our economy. And mainly when you look at anything to do with borrowing and buying and making large purchases. People haven't done it. It's slowed significantly. The good factor in that, though, the good news about that, though, is anybody that bought any kind of real estate, they've been building equity. The longer you stay in your home, you're paying down your balance and it's going up in value. Now, when it comes to getting a loan for a house, you have to understand that the more inventory we have, it's going to roll into a buyer's market. And I foresee that happening come 2026, spring of 2026. You also have to know, people ask me all the time, Wayne, when's the best time to sell a house? Listen, more homes are bought in the spring and summer months. More homes are sold in the spring and summer months. Also, more buyers are buying houses in the spring and summer months, and more sellers are putting their homes on the market in the spring or summer months. So like right now, for example, the interest rate is going to be lowered. The inventory of homes is the highest it's been in 5 years. So there's more and more houses coming on the market because more and more people are being receptive to, wait a minute, the rates drop. I got a 5% rate, but if I can move, roll my equity, put it, this is my payment, I'm going to be good. I'm not going to put a pool in my house. I'm going to buy a house with a pool. It's cheaper. So all of that goes into factoring when to buy a house. But here's something that you have to consider. I'm walking around a brand new home, for example, and right now we're rolling into a buyer's market. That means it's advantageous for a buyer. There's more inventory on the market and there's less people buying homes. I'll give you a couple statistics. The National Home Builders Association said there's more spec homes sitting vacant right now. Now, real estate's hyper-local. In some markets, it's moving like crazy. In some markets, and maybe it's your market, you see brand new homes sitting on the market, and builders are offering incentives, really good incentives. Like, I'm talking 3% fixed rate for the first year, 4% for the second year, and 5% every year after that. The moral of the story is do your research, do your homework, educate yourself, and make sure whatever you do, you get a fixed rate mortgage. Adjustable rate mortgages are pretty risky. And unless you know you're only going to be in the house 2 to 3 years, but even then, there's no guarantee in life, right? So I'm Wayne Turner. Thank you for watching. Subscribe to the channel. Leave a comment. Ask me questions. Give me a thumbs up. And most importantly, thank you once again for watching, and God bless.